Welcome back to the Daily Crypto Roundup. Today is one of those days where the market looks ugly on the surface, but underneath the red candles, there are actually a few very important stories developing. Bitcoin has slipped back toward the $60,000 area. Ethereum is under pressure again. XRP is testing lower levels. Solana is weak, and the wider altcoin market is feeling that same risk-off mood. So in today's episode, we're going to walk through where prices are right now, why Bitcoin is struggling while AI and tech stocks are still attracting capital, what this latest move means for the Bitcoin cycle, why the strategy and Bitcoin treasury trade is coming under pressure, what is happening in Washington with the Clarity Act and the CBDC ban, and then we'll get into Cardano, XRP Ledger, Ethereum treasury accumulation, and the next big battle in crypto derivatives. As always, none of this is financial advice. This is crypto news, market analysis, and my opinion on what these stories could mean. Before we get into the market, a quick word from Kraken, because this is one of the main ways we keep the show going. If you are already trading crypto or you're planning to use an exchange, you can support the podcast by signing up through our Kraken link. We're also giving away 20 XRP to listeners who sign up through that link and use Kraken. It costs you nothing extra, it helps support the show, and it means we can keep putting out these daily roundups, deep dives, and market updates. So if you're trading anyway and you want to support what we're building here, the Kraken link is in the description. We appreciate every single one of you who uses it. Now let's get into the prices. Bitcoin is trading around $59,900, down sharply on the day and now sitting right around that psychological $60,000 level. Ethereum is around $1,597. XRP is around $1.056. BNB is around $553. Solana is around $66.76. Dogecoin is around 7.4 cents. Tron is around 32.6 cents. Cardano is around 14.1 cents. Chainlink is around $7.32. And Avalanche is around $6.19. So the picture is pretty clear. The majors are red, the altcoins are red, and the market is not getting the kind of bounce people were hoping for. The lead story today is Bitcoin falling back towards $60,000 as investors appear to be rotating into other parts of the market, especially tech and AI. CoinDesk framed this as crypto continuing to struggle while the AI trade keeps pulling in attention and capital. That matters because Bitcoin is not falling in isolation. Gold and oil have also been under pressure, which suggests that the broader hard asset trade is losing momentum right now. That is important, because for a long time, the big Bitcoin argument was simple. Government debt is rising, fiat currencies are being diluted, central banks cannot stay disciplined forever, so investors will look for scarce assets like Bitcoin and gold. But today, the market is telling a slightly different story. Investors are not necessarily hiding in hard assets. A lot of them are still chasing growth, and right now the biggest growth story is artificial intelligence. That does not mean Bitcoin is finished. It means Bitcoin is competing for capital. And in this phase of the market, AI stocks, tech names, private companies, and high-growth narratives are taking some of the oxygen out of the room. The second big Bitcoin story is the rainbow chart. Bitcoin has now broken below the lowest band of the famous Bitcoin rainbow chart and entered what is known as the old Bitcoin is dead zone. Now that sounds dramatic, but we need to be careful with it. The rainbow chart is not a magic prediction tool. It is a sentiment model. It shows where Bitcoin is trading compared with old long-term cycle behavior. The interesting part is not that the chart says Bitcoin is dead. It does not. The interesting part is that Bitcoin is now behaving differently from the old 4-year cycle models that a lot of people have used for years. In the past, when Bitcoin reached extreme pessimism zones, it often marked major long-term opportunities. But the market has changed. We now have ETFs, institutions, public companies, derivatives, treasury strategies, and macro flows all affecting price. So the real question is this: is Bitcoin deeply undervalued here, or are the old models simply breaking because Bitcoin is now a much more mature asset? That is the key debate. And honestly, Both sides have a point. If you are bullish, you can argue that fear is exactly what you expect near major lows. Bitcoin near $60,000 after previously trading much higher looks painful, but long-term holders have seen these phases before. If you are bearish, you can argue that Bitcoin has lost momentum, the cycle has weakened, and the old halving-based price models no longer have the same power. The truth is probably somewhere in the middle. Bitcoin is not dead, but the easy cycle narrative is damaged. The market now needs a stronger reason to move higher than simply saying, "The halving happened, therefore price must go up." And that brings us to the strategy and Bitcoin treasury story. One of the biggest risks in this market is not just Bitcoin's price. It is the companies that have built their entire identity around holding Bitcoin. Strategy, the company associated with Michael Saylor's Bitcoin accumulation model, is under more scrutiny as the market falls. The concern is not necessarily that Strategy is about to collapse. The concern is whether the Bitcoin treasury trade still works if Bitcoin keeps falling, equity prices keep weakening, and financing conditions get tighter. CryptoQuant has reportedly warned that Strategy should stop buying Bitcoin and focus on strengthening its cash position. Peter Schiff has also warned that if the stock keeps falling, Strategy could eventually face pressure around how it handles its balance sheet. Now, Schiff is obviously a longtime Bitcoin critic, so we need to take that with context. But the broader point is worth paying attention to. Bitcoin treasury companies are not the same as people holding Bitcoin in cold storage. Public companies have shareholders. They have preferred stock obligations. They have financing needs. They have market pressure. And if the stock market starts questioning the model, the story becomes more complicated. That does not mean Saylor is wrong long-term, but it does mean the market is stress-testing the Bitcoin treasury strategy in real time. And this matters beyond strategy, because Ethereum is now seeing its own version of the treasury trade. Crypto.News has a story today looking at Bitmine and the idea of an Ethereum treasury model. The bullish argument is that if companies buy Ethereum, stake it, and take that Ethereum out of the liquid trading supply, then a future wave of demand could hit a much thinner market. That creates the possibility of a supply squeeze. That is the hopeful Ethereum argument. The bearish argument is that treasury models work brilliantly on the way up and get very uncomfortable on the way down. So Ethereum investors now have to ask the same question Bitcoin investors are asking. Is this a smart long-term accumulation strategy, or is it another market structure risk if prices keep falling? Now let's move to Washington, because today's regulatory story is also important. CoinDesk reports that President Trump has refused to sign a housing bill that included a 4-year ban on a Federal Reserve central bank digital currency. That CBDC ban was welcomed by many in the crypto industry because it would have blocked a US digital dollar for several years. But the signing has been delayed because Trump is demanding action on separate election legislation. The crypto angle here is the Clarity Act. The Clarity Act is one of the biggest pieces of crypto market structure legislation in the United States, and timing matters. Congress only has a limited window before the summer break. If political fights over other bills eat up the calendar, that could delay or weaken the progress of crypto regulation. And this is one of the most important things for listeners to understand. Crypto markets do not just move on charts anymore. They move on legislation, court cases, ETFs, banking access, exchange rules, and institutional custody. If Washington gets clear rules in place, that can unlock more capital. If Washington delays, fights, or adds uncertainty, markets can stay nervous. Now let's move into Cardano, because today there is a major security story. SecondFi, the Cardano wallet formerly known as Yoroi, has suffered an exploit. CoinDesk reports that 3 attacks drained around 16 million coins, worth about $2.4 million, from 374 wallets. The team also rescued another 129 million before attackers could reach it, but Slowmist estimates that total losses could potentially exceed $20 million once everything is fully audited. This is a bad story for Cardano holders, especially because ADA is already under price pressure. The worrying part is that the vulnerability was apparently tied to wallet generation software, not simply someone falling for a basic phishing scam. That means affected users could not necessarily protect themselves just by moving a seed phrase to a different wallet. The bigger lesson is the same one crypto keeps teaching us. Self-custody is powerful, but wallet security has to be taken seriously. And when wallet infrastructure fails, ordinary users can get hurt very quickly. Now let's turn to XRP. There is actually a more positive XRP Ledger story today. Crypto.News reports that Halborn completed a re-audit of Ripple's XRP Ledger lending protocol and found 0 critical and 0 high-risk flaws. The review looked at code changes tied to fixed-term loans and single-asset vaults, and Ripple addressed all reported findings. This matters because even while XRP's price is weak, the XRP Ledger infrastructure story is still moving forward. The lending protocol is designed to support on-chain, fixed-term lending using pooled funds from a single asset vault with off-chain underwriting rather than the usual over-collateralized DeFi model. That is important because XRP needs more than price speculation. It needs real utility, real products, real institutional rails, and real reasons for developers and capital to use the ledger. A clean re-audit does not guarantee adoption, but it does reduce one area of technical concern. So today's XRP picture is mixed. The price is weak, sentiment is weak, but the infrastructure side is not dead. In fact, that is where the more interesting long-term story may be forming. Finally, let's talk derivatives and prediction markets, because this could become a much bigger theme. Crypto.News has a piece looking at the legal battle between CME and the CFTC over perpetual futures. Perpetuals are one of the biggest products in all of crypto trading, and for years, most of that volume has lived offshore. The fight now is about how these products are legally classified in the United States, who gets to offer them, and whether regulated American markets can bring more of that volume onshore. That sounds technical, but it is actually massive. If crypto perpetuals become easier to offer in the US under a regulated framework, that could reshape exchange competition, market liquidity, and how institutions access crypto. If the rules become stricter, the advantage may go back to the biggest incumbents. So when we zoom out, today's market looks weak, but the deeper stories are not small. Bitcoin is testing $60,000. Old cycle models are breaking down. Treasury companies are under pressure. Washington's crypto agenda is facing timing risk. Cardano has a serious wallet security issue. XRP Ledger has a positive audit story. Ethereum treasury strategies are being tested. And the future of regulated crypto derivatives in the United States is being fought over right now. So the message today is simple. Do not panic, but do not ignore the shift either. This market is changing. It is becoming more institutional, more political, more connected to public markets, and more dependent on regulation and infrastructure. The old crypto cycle was mostly about hype, halvings, retail momentum, and liquidity. The new crypto cycle is about balance sheets, ETFs, legislation, security, custody, treasury strategies, and whether real products can survive when prices are falling. That is uncomfortable, but it is also how markets mature. Red days feel brutal, especially when Bitcoin is near $60,000 and altcoins are bleeding. But these are the days where we find out which stories are real and which stories were only built for a bull market. As always, stay calm, manage your risk, never invest more than you can afford to lose, and keep your eyes on the bigger picture. Like and follow. Check out the Kraken link in the description if you want to support the show, and we will see you at the top.